I made over $12,000 in a day, all from one single trade that I took in the London session across 5 accounts. The trade was a 400-point trade, and in this video I'm going to be sharing with you guys exactly how to trade the London session, because I truly believe if you listen to the information I'm going to share with you guys in this video, you're going to be able to do the same things, because it's about what you know and how you apply it. And as we get further in this video, you're going to see exactly how I apply myself so I'm able to capitalize on these moves in the London session. For those who are nosy and want to see the actual trade, I know some of you guys actually want to see what the actual trade looked like. As you can see, taken in the London session, caught the absolute high of the day and just held for a price to melt and hit my take profit. Very simple trade, very simple ideas built around this trade. I'm going to be sharing with you exactly what I look for in the London session, my high time frame approach that allows me to go in the lower time frame to be able to execute on these trades, the things that I look for and how the setup forms, and what I'm looking for when the setup is forming. Now, for all the guys that are going to be thinking that this is all hindsight, I just happened to take the trade and not know what I was looking for. As you can see, this trade was actually posted in my Telegram for free. As you can see, I posted where I thought price was going to go today during the London session, and as you can see, there was a follow through of the targets getting hit. When it comes to trading the London session, there are a few key components that you need to be able to consistently trade the London session and to be able to consistently catch good moves. By no way, shape or form am I saying you're going to be able to have a 100% win rate, you're going to be a millionaire by tomorrow, but no, what I'm sharing with you are the essential frameworks that I use that allow me to be able to consistently catch moves in the London session. The first and most important thing I really recommend you guys to adopt when it comes to trading in general, but specifically when it comes to trading the London session, and the reason why I say is because the London session, if you think about it, right, it's the start of the day. You don't have any information to work with on the day other than the Asian session, which typically consolidates, or the previous day. If we're talking just about a brand new day, you don't have a lot of reference points to use. So I highly recommend that you guys use a high time frame framework, and that high time frame framework is going to act as a guide for you when you're actually trading the London session, because if you have a high time frame bias, you know exactly what you're going to be looking for on the lower time frame. So it's just a matter of just then waiting for the London session to start, and then you know what you're looking for in the London session that's in line with your high time frame bias. So the high time frame acts as a guiding principle for what you should be doing and looking for in London. And I know a lot of you guys always getting confused with bias and, oh my god, how do I figure out bias? How do I know where the market is going to reach for in the high time frame? Now, I'm going to break down to you guys two simple concepts, right? The market is only ever doing two things. It's either seeking for liquidity, I don't know if I can type today, or inefficiencies. I don't know if I typed that right. Forgive me if I didn't. I probably didn't, did I? Inefficiencies, yeah, whatever. I probably didn't type that right. The market is either seeking liquidity or inefficiencies. So on the high time frame, what you want to do is you're going to be looking for the nearest inefficiency, which is going to be the form of a fair value gap or a new week opening gap or a point of liquidity. And that liquidity could be an old low, a previous week low, a monthly low, whatever liquidity that is close to price, or whatever inefficiency that is close to price. If price seeks liquidity or inefficiencies, if price is near a high time frame liquidity, then that means that there's going to be a high likely chance that price is going to be able to draw to that level. If there's an inefficiency that's relatively close to price and price hasn't traded to it, there's a high probability chance that price is going to seek that inefficiency if there's no opposing PD array. And what do I mean by that? So say, for example, we have this high here, right? Like so, we have this high here. Let's say there was an order block here, right? An order block here. The order block is the opposing PD array. Let's say this order block was violated. So that means that there's nothing stopping from price running that high. So then that means there's a high likely chance that price is going to what? Trade above and reach that liquidity, because one of its key functions is to seek liquidity or inefficiencies. So an easy thing to remember is that if price is near a liquidity pool and there's no resistance that's in the way of price in the form of a breaker, order block, fair value gap, there's going to be a high likely chance that price is going to trade into it. And if price is retracing and coming back into the range, and there's some fair value gaps within the range that is coming back into, for example, it makes a high up here and starts to trade back into the range like this, right? Once it's trading back into the range, let's say there's some fair value gaps down here, If price is trading back into the range here, and there's nothing in the way of price reaching that fair value gap, there's going to be a high likely chance that price is going to reach into that fair value gap. And what you then do is simply you anticipate that price is going to reach into this fair value gap, or is going to reach up into that high, and the distance between where price currently is to that high, or where price currently is to that fair value gap, that's the pocket of price that you frame your bias essentially, because you then anticipate that you're going to have a bearish bias because you're anticipating price to reach into that. And it was using these ideas, that is exactly how I was then able to then go and frame that bearish setup that I took on the sales today. I simply was just looking at the market. So we saw this push higher at the start of the week, right? And I thought, okay, maybe there's a nearby old daily high. So my eyes were looking at that high thinking, okay, I want to see price trade to that, because we've had a massive push. We made a new week opening gap, a form of an inefficiency, right? Price is near this old daily high, so there's a high likely chance that price is going to reach into that high. And what happens? This bearish order block has not been violated yet. I did post in my free Telegram that I was anticipating that this was going to be ran. Of course it didn't, and that's fine. I'm not going to get it right all the time. But then I waited. You then wait to see what price is doing. So I then saw that, okay, price showed a massive rejection. It attempted to go above the 50% of this bearish order block, right? Which is the last defensive mechanism of an order block. If 50% of a bearish order block is violated, that means that order block is no longer valid. So by virtue of it rejecting or failing to hold into that level and showing that nice rejection here, I saw that, okay, this bearish order block has been respected. So price then traded back into the range, and I was thinking, okay, what's near? Well, we had that new week opening gap right at the start of the week that was never filled. So if price is rejected off a bearish order block when it could have gone higher and gone into all-time highs, but shown a major rejection off there, and is now trading back into the range relatively close to an efficiency, what do you think the most likely draw for price is? It's going to be that new week opening gap. So that's where the logic for me came from of why I was looking for the new week opening gap. And I'm going to use that to anticipate bearishness within the market, and I'm going to frame bearish setups. And that was what gave me my bias. And all I'm going to do is I'm going to go into the London session, and I'm going to be looking for confirmations that price wants to be in line within the overall direction I'm anticipating. So now you might be thinking, well, what are those confirmations and what are those frameworks that you're using to be able to dictate and see whether price is going to be bearish or not? Well, that's very simple. A high probability price delivery typically has a form of accumulation, manipulation, and distribution, mainly the manipulation and distribution. So if I'm anticipating bearishness like I was on this day, I'm going to be going into the London session and looking for a degree of manipulation in the opposing direction of the bearishness. So that means I'm going to be simply looking for the market to go higher before it goes lower. And that's it. And the move higher is going to be the manipulation aspect of that price run, right? Because I'm anticipating that price is going to sell off. So I want to see manipulation in the opposing direction. And if I see a move in the opposing direction at a key time of day, like the London session in the London Open, that means that that's going to be a high likely chance that price is going to be setting up a manipulation aspect of that delivery. And how do I gauge that manipulation? Well, we use the opening price at midnight New York times. All I want to see is that, for example, let's say this is the opening price, right? I want to see price go above that opening price, and that's what we're going to deem as manipulation, because that's going to be the opposing move against the intended direction of price. Once I see price trade above the opening price, because I'm anticipating sells, I then simply just wait for price to trade into an opposing PDRA, which could be a liquidity pool or an inefficiency, because price is only ever seeking two things, liquidity or inefficiencies. And then I'm just going to wait for confirmation, and then I'm then participating. Of course, in the trade I took today, when I do break it down later, you're going to see why I took the exact high of the day, because there's a lot of other things that were into it, which I'm going to talk about and cover in just a moment. The main important thing is the midnight opening price. I'm using that to gauge manipulation, because manipulation is important to see if we're anticipating a high probability price run. That's it. So I simply want to see a move in the opposite direction above the opening price at the right time of day, because it's time and price. Because price opens, right? Think about it. Price opens at London, trades above the opening price, and the opening price is where typically manipulation occurs. So that means that if I'm seeing a move against my intended direction, there's going to be a high probability chance that I am literally watching the manipulation happen. And then I'm then just looking for London algorithmic behaviors, right? Don't get too confused on the fancy words like London algorithmic behaviors. All I'm simply saying is that in London, typically what London does is that at the open, let's say for example, I'm bearish, right? What you're going to typically see is that on the 15-minute chart, you should be looking for, you're going to want to write this down. You're going to be marking out any equal highs or equal lows that are relatively close from where price is currently trading. You're going to be marking out your 15-minute FVGs, you're going to mark out your hourly FVGs, and then you're going to mark out your 4-hour FVGs. And typically what you're going to see is that some are going to be confluencing with each other, and then you're going to be looking and anticipating for price to trade into one of these areas. And typically what you're going to see is that in London, price typically trades back into the range, trades into a 15-minute fair value gap, or trades above some equal highs or equal lows, depending on obviously the direction we're anticipating price to go to, or typically trades into an hourly fair value gap or 4-hour fair value gap. All you're doing is anticipating that to happen near the open at the start of the London session as the first move that happens in London, because that's going to indicate the intention of that this is going to be most likely manipulation. So all I'm simply waiting for is for price to trade, right, into that level, like so. This could be a 15-minute fair value gap, hourly fair value gap, right? Trades into that level, and then I'm simply waiting to see if price is actually going to turn around, and that's going to happen by a way of confirmation. So I want to see a market structure that's going to be going towards the intended direction of price. So if I'm anticipating bearishness, I want to see price trade into a 15-minute fair value gap, an hourly fair value gap, a 4-hour fair value gap, into a pool of liquidity, right? And then I want to see a break in market structure to the downside, because obviously I'm anticipating bearishness. That break in market structure with displacement, that's going to confirm to me that, okay, this opposing PD array has actually supported the turnaround of price. And once I see that, I'm just simply waiting for the retrade of the range that broke or traded into that opposing PD array, and I'm going to trade the retrade off that, targeting the fair value gap that would have formed as price broke this market structure here. And I'm simply entering at that fair value gap with high confidence. My stop loss, I'm going to be setting it at the high that formed before the break in market structure, and then I'm going to adjust and manage the trade accordingly from that. That's all I'm looking for in the London session. I'm not looking for anything fancy. I'm not looking for anything super technical. Those are the frameworks I'm using. I'm just taking a high time frame framework, a high time frame bias, looking for signs and confirmations that the bias is going to hold, and those confirmations come by way of seeing the manipulation, price trading above the opening price if we're bearish, breaking structure to the downside after trading into an opposing PD array. How it sets up on the lower time frame is what confirms the bias, the high time frame bias. And I know some of you guys might have light bulb moments right now, but the bias is confirmed by how price sets up as it's forming the daily range in the London session. I'm going to break down the setup I took today, and you're going to see elements of this within that trade setup. All right, so going into that setup that I took today, so we had a high time frame framework, which I've already broken down to you guys, which was we had that overall draw of that new week opening gap, and we're using that to anticipate bearish price delivery until price reaches into that opening gap. So that allowed me to frame a high time frame bias of bearishness, and that allows me to go into the markets to look for sell setups. All right, so at 2 o'clock, what do you see? You see at 2 o'clock, the main first move at 2 o'clock, what happened? Already anticipating bearish price action. We're seeing at 2 o'clock, we're seeing an opposing move. We have these relative equal highs right here. And the reason why I say mark out liquidity pools like equal highs and equal lows is because these are higher probability forms of liquidity, right? There's going to be a lot of buy stops and sell stops resting above and below equal highs and equal lows. We see price trade up into that level of liquidity, and coupled near that level of liquidity, there's a 15-minute fair value gap. I don't know if I can go to the 15-minute to actually show you guys how much more cleaner it actually looked, right? So if we have that 15-minute fair value gap here, as you can see, we have equal highs. We have a first move in the London session open as the opposing move. We have a high time from anticipation that price is going to be drawing down into the new week opening gap. Do you see how these are building confluences to a high probability that this move here, this first move is probably manipulation, and there's a high likely chance that price is going to be delivering on the sell side. already were coming in for high time frame price anyway. So I'm stacking these multiple confluences during a key time of day and blending time of day. These things are happening at a key time of day where manipulation happens above the opening price. So this builds a high probability setup. Not saying it's 100% going to work, because there's going to be times that it doesn't work, right? But this builds a high probability setup, and that gives us confidence to be able to execute on this trade. So that's when I saw this happen, right? I then went short above these equal highs going into that 15-minute fair value gap. I didn't have to wait for confirmation. Obviously, it's a little bit more for a risky setup, right? We're going to go into the confirmation in a minute. But the reason why I was trading that and going short here is because I was looking at this range here of where the 15-minute fair value gap is. And I was thinking, okay, there's 15-minute fair value gap. If this should hold price, I can have relatively my stop just a little bit above this high here. And then my stop is going to be safe, because that's the most recent high prior to that 15-minute fair value gap forming. That's why I put my stop loss up here. And then as you can see, we had that beautiful delivery to the sell side, and we end up trading into that new week opening gap all the way at this level. And what could you be targeting along the way? You guys might be thinking, well, if you're bearish, right, you're going to want to be targeting the opposing liquidity pools, which can be previous session lows, previous daily lows, previous 3 days lows. Those are going to be your target. So as you can see, we trade into that 15-minute fair value gap, and then look at this beauty. We break market structure here after trading into a 15-minute fair value gap above relative equal highs. We have that displacement because of that fair value gap forming, which is part of that pricing that breaks that low. And then we have a retrade into the fair value gap that formed as part of this range, right? So this range here, this range here, we have fair value gaps in here. And then as you can see, price respected this range. And if you want to see even more cleaner, on the 15-minute, we have that 15-minute fair value gap, relative equal highs, break market structure here, retrade off that 15-minute fair value gap. That's part of that break in market structure. And then we had a beautiful melt over like 500 points. It was like a 500 point move. And that's it, guys. That's all I'm doing. I'm just looking for these frameworks and these supporting ideas in the London session, and then I'm just executing. Now, if you guys don't like trading the London session and might find it a bit too confusing, and you want to use a different session like the AM session, I do have a YouTube video on how to trade the AM session. Be sure to go check that. I'm going to link it right here. I do also have a video on market structure and how to trade market structure if you guys are a little bit confused on how to trade market structure, because I know I didn't really go into detail with it today. But I have made a video on that on my YouTube channel. Go check that. I'm going to leave that link in the description below. Be sure to join my free Telegram. I'm only going to allow maybe 20 people to join. Let me know in the comments what you found valuable. Let me know in the comments as well what other videos I should make. Like, comment, subscribe, and I'll see you guys in the next video.